Here's the process. Here's my early conclusions. This is my bullets of thoughts. This is the futures only portion of the CFTC report. Down then up. That was a note that I wrote to myself. Oh, that's better. This is the futures and options together. I haven't gone through that. We'll go through it together. Let me just take a look at one name here. Okay. Yeah. All right, good. So nothing jumps out as horribly contradicting my original thought. I do have some well-formed early opinions that hopefully we would be able to get. Well, you would not be able to get this if I'm right. If I'm wrong, you'll know to tell me I'm wrong. But I think I'm right about this. All right, so here we go. The theme today is, and I'm going to bring up this. The overview is, let's start off with, are we bullish or not? Okay. Looking at this chart, the gold line is the gold price. The red line, you don't care about the blue line for this conversation. The red line is the open interest. The open interest, as Randy has mentioned to me before, this line here that Randy has, it basically was a reference point line that he put there a long time ago, maybe 3 years ago almost. And for some reason, the market seems to know it's there lately. So, all right. So you start off with this chart and you say to yourself, what does this mean? Well, on the surface of it, if the market is behaving normally, which it is the last 7 days, okay, whatever normal means these days. If the market is behaving normally, then when the open interest goes up, that's because funds are getting in. This market is biased towards funds initiating long, not initiating short. They initiate long, they get out, some of them get short. Now, there are funds that initiate short, but by and large, the biggest players initiate long. Okay, your small CTAs, your small funds, and your day trading types will sell it short most of the time. All right, that's the first thing. So with that in mind, when the market goes up and the open interest goes up with it, you're looking at a market that the funds are getting in. They're beginning to commit. So the question is, will they continue committing or is it a short-term thing? Well, over the last 2 years, they have continued committing in a big way. So usually your biggest, smartest money buys at the bottom where the open interest turns, okay? And let's say your least capitalized money buys at the top. So the biggest money says, I can catch the falling knife. And the shallowest money, the day trading mentality says, I'm going to buy it for 5 minutes, trying to get a new high, right? So that's the mentality. So it's a big sine curve. It's smart money gets long, regular money gets long, shallow pocketed, stupid in terms of information flow, but smart in terms of risk management buys the money, right? So it's like we used to call, example would be Paul Tudor Jones buys, a regular hedge fund buys, and then a CTA buys or I buy. All right. When the market's not behaving to form, we don't see that. So what is the algorithm that we use when we look at this? Because it's in play right now. I don't usually focus on this lately, but it's in play right now. And that algorithm is this. Funds determine direction. Banks determine magnitude. Is it always like that? Forever it was. But for the last year, especially in the last 4 to 6 months, it has not been like that almost at all because this market has been in turmoil. But that's another in-depth conversation. So when I say the market direction is determined by the funds, whatever they do, the market does. When they get in, it goes up. When they get out, it goes down. That's the funds coming in. The speculators are coming in. The speculators are getting out. The speculators get short. The speculators cover. The speculators come in. The speculators get out. That's how it works. The banks are the market makers, although they haven't been very good at their job over the last year. but the banks are the market makers. The banks determine how far the market goes. So the funds say, I'm going to buy it, and the banks sell it to them. The banks make the market. So 5,000 contracts come in on Monday, any day, a random day, and the banks say, oh, it's going up, and the banks back away. They let it go up. They let them come to them. It's like a mousetrap, right? And then when the banks say, I'm not going to let it go any higher, it runs into a wall. That wall is usually predicated on one of three things. One is either they know it's going down, they're bearish, genuinely bearish, or they have a seller right above. And the seller right above is historically producers, but it can be anyone. They have selling flow historically. They haven't had a lot lately. Okay, so the funds determine direction and the banks determine magnitude. On another day, 5,000 contracts come in, and the banks may say, oh, and they may back all the way away, and the market can run all the way up. And that's the banks not having order flow above them. The banks are the tell in the poker match, how they behave normally. So what are the banks? Why am I bringing this up and refreshing us on this now, even the older guys? Because this week, these past 8 days have been a return to that behavior. Not 100% return, but we got a fish hook. I'll go through that in a second. We got open interest bottoming, and we got open interest turning associated with the rally. Now this little section here that I'm going through, I'm talking about here. I'm talking about this. And yes, that's a fish hook, but the actual trading fish hook comes in right here. Okay? So what are we looking at here? We're looking at a market that is acting like it used to act. However, it hasn't been acting like that for months. So here's what I mean. In a normal gold market, the yellow line goes up, the open interest goes up. The yellow line goes up, the open interest goes up. Yellow line goes up, open interest goes up, all the way to here, right? Now in this area here, yellow line goes sideways, open interest goes down. This is a sign. This is an early sign. We saw this a couple times that the market, not an early sign, we saw it before as well, that the funds were selling, but the banks were not letting it drop. Remember, the banks determine how far it goes. The banks were catching the knife really high, all right? That's because they were short covering. And then it just all hell broke loose, and the market started rallying, and the market and the open interest dropped. That is a divergence from historical behavior, meaning somebody who was short initiated the move higher. That wasn't the fund saying, oh, I'm bullish, let's get in. It was the banks and other shorts, mostly the banks, saying, I'm nervous, let's get out. And they bought into strength, and the funds that were long sold into strength, booking profits. This is a major divergence. We see this all the time for minutes, hours, and days, but we're talking about months here. Now, the behavior happened, it coincided with two things. One, it coincided with Liberation Day, and two, even though it seems like it may be the same, it coincided with the repatriation of gold to the U.S. Now, I'm going to discuss this conceptually in a little bit because I think it's important. But this is your normal gold. Market goes up, open interest goes up. Market goes down, open interest goes down. And this is where we are now. That's where we are. And we're in the process. We're in a situation now. I may be speaking animated and I may seem emotional. I'm not outrageous.